So welcome to this video. In this video, we are going to look at equity valuation and the ratios involved. So this question was asked in December 2012. So we'll start from the required. So there's a huge list of requirements. So there is section A, B and C. A deals with valuation of equity. The B is a theory question and the C is a kind of a ratios question. So we'll start with A. Calculate the value of GCO using the following methods. So we have to value equity shares using market capitalization, net asset value on liquidation basis, price earnings ratio using the business sector average PE ratio, dividend growth model using the average historic dividend growth rate, and Gordon's growth model, which is the BR model. So that's about the questions that are being asked. And for C, we have to calculate the following values for GCO: the before tax market value of the bonds, debit equity ratio using book value method, debit equity ratio using market value method, and there's also a theory question here. So that's about the marks allocated for this lengthy question. So this question will summarize all the small ratios that we have calculated for equity valuation. So we'll start from the question. So we'll read the question entirely and then we will start to work out the ratios. GCO is a listed company which is seen as a potential target for acquisition by financial analysts. The value of the company has therefore been a matter of public debate in recent weeks, and the following financial information is available. So they have given you year from 2009 to 12, 4 years data they have given. They have given you profit after tax in million, then they have given you total dividends in million, and they have also given the statement of financial position for the 2012 year. So we have inventory, we have non-current asset, inventory, trade receivable, ordinary shares, reserve, bonds and current liabilities. So they have given a lengthy amount of information. Then they have given us the shares of GCO have a normal value of 50 cents per share and market value of $4 per share. The cost of equity of the company is 9% per year. The business sector of GCO has an average PE ratio of 17 times. The 8% bonds are redeemable at a nominal par value of 100 in 7 years time, and the before tax cost of debt of GCO is 6% per year. The expected net realizable values of the non-current assets and the inventory are 86 million and 4.2 million respectively. In the event of liquidation, only 80% of the trade receivables are expected to be collectible. So it is a lengthy amount of information. So all information have been mixed and we have to work out each of these methods individual basis. I have already created a format for this problem. So our job would be to insert the numbers so that we could finish the sum really quickly. So we'll start. So first we'll try to find out the requirement A1, which is the market capitalization. So market capitalization, we need the number of equity shares to do it. So first we'll start from the book value. So there are 20 million shares and each share is worth 50 cents. This will give us the total number of shares. So there are 40 million shares, and what is their worth? Their worth will be 40 million shares into per share value. So the per share value is $4 per share. So we'll multiply. So this is a dollar and it's in million. So we got the first number. So the next method is net asset method. So in net asset method, we have to add all the assets value and deduct the liabilities value. So we'll get the net asset value. So It's up to us to find out either it in per share value or as a whole amount. So the question is not like very clear as to whether it's asking a per share value or whole amount. Better we'll calculate everything in a whole amount value itself. So we'll start. So let's see. For realization, they have said here the non-current asset will be 86 million and the inventory will be 4.2 million. So non-current will be 86 and inventory will be 4.2 and respectively. In the event of liquidation, only 80% of the trade receivables are expected to be collected. So receivables will be only 80% that can be collected. So we'll work it out. 80% into the receivables amount. The receivables amount comes to 4.5. We'll do the workings here. Okay, so this will give us our total asset. So we have taken non-current asset, inventory and trade receivable. If we want, we can have it, or we can also delete it if we don't want. So the non-current liability will be 25 and the current liability will be 7.1. So we can take those numbers. So current liability is 25. So we'll take it as a negative number and this will be 7.1. So that will be in dollars amount. So NAV method is $61.7 million. So the next method that we are going to work out is PE method. So PE method formula is this. There are two formulas for PE method. So one is the market cap divided by total earnings. So this will give you the entire total company's worth. Or there's another formula where PE refers to current market price divided by earnings per share. So this formula will give you the per share value, okay, and you can find out PE through per share value. This formula will give you the total value because it uses total value of shares divided by total earnings. So the market cap can also refers to the total value of the company. So we can have total value. So you can use any heading, either it as a total value or total earnings. We'll use a total earning, total value. So we'll insert whatever numbers that we have. So this question has said that the P is 17 and the total value we don't know, divided by the total earnings. So let's see whether we have total earnings. Yes, we have here profit after tax. That is the number we want. The latest number is what we want. So it is 10.1. So that's about the formula. So now what we'll do, we'll try to find out the total value. So the total value will be 17 into 10.1. Okay, and when we work out this, the value would come to 171.7. So this would be in terms of the million. So that's about the PE method. So we'll move on to the next method. The next method is a dividend growth model. So they're asking us to work out the growth in the dividend through two formulas. So one is the historic growth model and the other one is the Gordon model. So first we'll find out through the historic model. So the G has a formula. Okay, so the formula would be like this. The G equals to latest dividend divided by oldest dividend. You have to take a square, you have to take a nth root, as we can't take a nth root here. What we'll do, we'll find out through 1 divided by n. This will also will give you the same result. So once you get this answer, okay, once you have finished all the answer, minus by 1 and also multiply by 100, you will get G as a percentage. So we'll have the formula. So this is a formula here. So we'll work out the G here. So G will be the latest dividend. So latest dividend in our form, in our sum will be latest dividend is 6 and the oldest dividend is 5. So how many number of years? The number of years is 9 to 10 is 1 year, 10 to 11 is second year, 11 to 12 is third year. So there are only 3 years in this information. Okay, so we'll enter. So we'll start. 6 divided by 5, close the bracket, to the power of 1 divided by n. N is 3. So again close the bracket. So first we'll find out this number. We'll find out right here. So we got 1.06. So from here we'll minus the 1. So with this number, if we minus the 1, the answer will be 0.062. And when you multiply this number by 100, you will get the percentage of growth. So the percentage is 6.2%. So now we have to value the equity using this. So how do we value equity? Through the dividend growth model. So the dividend growth model works like this. The formula. So we'll try to insert the numbers for this formula. The number would be D0 is 6, that is the latest dividend, 6 into 1 plus G. So 1.062 would be the dividend. So this is the numerator. We'll see the denominator. The denominator is KE minus G. What is KE? KE would be here. The cost of equity of the company is 9%. So we will take it as 0.09 minus G 0.062. Close the bracket. We'll get the answer. So we'll look at the answer now. We got 227. Okay, a number. This is it represents the million and in dollars. How do we know that? Because how the D0 works in this formula is what the final answer will be. The D0 that we took, the 6 number, is a dollar million. So 6 is a dollar million. So the answer will also be a dollar million. So this is the worth of the company. Okay. So the next method is the Gordon method. So in Gordon method, it works like this: G equals to B into R, where B refers to the retention rate and G and R refers to the rate of investment. So value of equity, we have to find it out. So the B formula is EPS minus DPS divided by EPS. So first we will find out the B. So we have to get the EPS. So EPS is either you can take EPS or even the whole number is fine. So we can take like this. So the profit refers to 10.1 and dividend is 6. So we'll start here. So it is 10.1 minus 6 divided by 10.1. So either you can take it as per share value or even the whole number value would equally work well. Because if you are going to use per share, the per share in the numerator and the per share in the denominator and in the enter formula will get cancelled out. So you can also work out like this and get the answer. So we'll see what is the answer here. Okay, so the B has come to 0.41. So now we have to find out the R. The R is an ROE. So ROE refers to return on equity. So return on equity can be The numerator is the profit after tax and the denominator is the equity. So the equity in this company is this number 67.2. So we have to find out 67.2. So this will give us our answer. So that comes to 0.15. So now we can find out the G here. So G would be 0.15 into 0.41 will give us the answer. But the answer that we get is actually a percentage. So we can multiply it by 100. We'll get the percentage number. So the growth is 6.15. From here on, we have to value the equity again. So we'll value the equity. So we'll have the same workings here. We'll take these numbers and we'll put it here. So the formula remains the same, and except for the growth rate is 6.15. So again, this would be 15615. So we'll get the answer now. So the answer comes to 223.4. So that's about the answer. We got it in millions, and so that's about this answer. So we'll move on to the C part. So in the C part, there are like three calculations which are required. One is the before tax market value of the bond, debit equity ratio in book value basis, and debit equity ratio in market value basis. So to value a bond, this is the format. We'll start. So we should have interest. Okay, we'll also have we should have interest. So interest is before tax. So we'll just have to find out the interest here. It is an 8% bond. So we can take it directly there. So it's going to be 8% bond. We'll also have to check the nominal value. The nominal value of the bond is 100. So we can take it as 8. And redemption value, we have to check. The are redeemable at a nominal par value of 100 per bond in 7 years time. So it is redeemable at 100. We also have to find out the years and the discount factor. So it says it is redeemable in 7 years time and the before tax cost of debt is 6%. So for 7 years time and 6% we have to look. But the concept is interest we are going to receive for 7 years. So we have to look at the annuity table for 7 years 6%. And for the redemption value, it's only a single cash flow that we will receive on the 7th year at a 6% discount factor. So we have to look at the discount factors table. So this is an annuity factor table. This is a discount factor table. So these are the numbers. So now we can pull it. So cash flow into discount factor, you'll get the number. Again, cash flow into discount factor, you'll get the number. Total both, you will get the before tax market value of the bond. So we don't want the value of one bond, we want the value of all the bonds. So try to find out what is the book value of all the bonds. It comes to 25 million. So we can put it like this: 25 million represents 100 value of nominal, but the market rate is 111.156. So that is how the bond should be valued. So we'll find out the entire worth of the bond. We'll put it here. So the entire value of the bond comes to 27.789. So now we'll move on to the next part, which is the equity ratio, debit equity ratio. We have to have two methods. One is the book value and the other is market value. Book value is very simple. So we can get the book value here. Debit value is 25 and equity value is 67.2. So that we can easily get 25 divided by 67.2. This will give us the answer. So this is the ratio here. And for market value, we have to get the market value of debt. The market value of debt is here. So we can take that number. It is 27.789 divided by the market value of equity is what we calculated on the top. So it comes to 160 here. So we can take that number. So we have got our answer. So we have got our answer here. So book value comes to 0.37 and market value comes to 0.17. So that's about this sum. It's a lengthy sum, but you can do it slowly and methodically. You will get the answer. So you should be like able to compute a problem both in the per share value and also the total value. The more the sum you do, the more the flexibility that you will get. So that's about this sum. Thank you very much for watching this video. We'll meet in the next video.